Thank you, Andrew, and thank you, Marine Money, for inviting me back to be here in Singapore for the 23rd Marine Money Asia event. As Andrew has alluded to, the title of my presentation today is A Strong and Inefficient Fundamentals. We'll try and get to the bottom of what I mean by this. I hope over the next 20 minutes or so to give you sort of a view of where the market currently is, why it's where it is at, and the future for the market in the coming years, and in some instances, a little further beyond that. I thought it would be a good opportunity just to start things off, as I'm sort of one of the first speakers for the conference, is just to give you a sense of where the market's gone over the last 12 months or so. These charts just show you the movements of earnings and values since the back end of August 2023 to September 2024. And we can see for the majority of sectors, we've seen positive movements in both earnings and values. Apart from LNG, where we have seen that market soften over the course of the last 12 months, everything else is positive. And in a lot of instances, it's not just positive, it's significantly positive. I mean, if you look at some of those percentages, you'd be, historically, you'd be lucky to see some of those over a period of 3 or 4 years, and we've seen them over a 12-month period. And the earnings of some sectors are now, I would say, high. If we compare today's earnings to the sort of record earnings that we've seen over the course of the last 10 years, so the high watermarks, which are dictated by the blue bars, the green circles, are where today's earnings are in relation to that 10-year high water mark. And we can see for a number of sectors, product tankers, chemicals, some of the gas sectors and offshore were at or near the sort of high water mark for the last 10 years. So the markets are performing generally very well, a very strong market. Now, for those who have not seen this slide before, this is my somewhat now infamous infographic of where are we on the earnings cycle. This infographic, it's not a chart, it's just an infographic, is designed just to show where each individual sector is on its own earnings cycle and the relative strength of one sector versus another. So if we start on the left-hand side here, we can see a large number of sectors where the fundamentals still remain strong, but earnings have perhaps just come off a little over the course of the last 12 months from the highs that have been created potentially by some of the froth on the top of the market. We can see LNG, as we know from the first chart, has fallen somewhat over the course of the last 12 months or so. That's firmly on the way down from an earnings profile perspective. Moving on to the right-hand side of the chart, we can see offshore. Now, offshore is a sector for the last few years that we've said we're going to see some improvement in this sector and for some time to come. We still think there's a little bit more runway to go in offshore. There's a lot of positivity there still to be played out. And then finally, and perhaps the most interesting one, is containers. Containers 12 months ago was firmly on the left-hand side of the chart, and now it's moved right over there, back again at the top of the market. Now, we were forecasting strong demand fundamentals for the container ship market this year. We could have all of course, see the strong and looming order book, but there's been a series of events that have perhaps been outside of shipping's control that have helped drive this market up, and I'll talk a little bit more about these events through my presentation. But that got me thinking. We seem to have seen a lot of events over the course of the last 5 years. I've nearly been in shipping now for 25 years, and I know you always remember the last 5 years more than you did 25 years ago, but the last 5 years have seemed to have been a lot of events, or as perhaps it's now more familiarly known, a black swan event. So I thought, being the scientist that I am, being the analyst I am, I needed to try and put some sort of numbers against this. So I used Google Trends, just to try and look to see how often the term black swan event is actually utilized in Google. And my sort of initial thoughts about the last 5 years being more black swan events than the last 25 years was born correct based on Google Trends, as we can clearly see on the chart on the screen. Now, these black swan events tend to happen, of course, we can't predict them, but what shipping tends to do exceptionally well is deal with them. We've seen a number of black swan events over the course of the last 5 years, and the industry is performing and has performed very favorably over this period. If we bring the black swan events down into more of a shipping parlance and we look at the BDI, I've just sort of overlain some black swan events over the course of this century. Not only has shipping done well, these events tend to increase volatility. And if we look at the volatility measure, if we look at the chart in the top left of the slide, we can see the volatility measures for the 2000s, the 2010s, and the 2020s. And we can see that actually, over the course of the last 5 years, this has been more volatile, even more volatile for the first 10 years of the century, when, of course, we saw the sort of the boom and bust associated with the supermarket cycle and then the financial crisis. So, yes, the market is volatile and is set to remain volatile while we see these black swan events going on. What I want to do now is just do a bit of a deeper dive into some of the demand fundamentals, starting off just by looking at an aggregate position where cargo growth has been over the last couple of years and where we expect to see it go. You can see the yellow bars are 2024, so we've had 9 months of the year. The remainder is the MSI forecast. We can see 2025. 2024, from a cargo demand perspective, has been positive across the board. 2023, we can see that container ships, we actually saw negative cargo growth. This year, it's certainly been positive. And we can see even in 2024 and 2025, we're continuing to see positive cargo growth, more so in many sectors than the average over the course of the last 10 years. So we're sitting in a positive demand growth environment. Now, if we drill down into some of the sort of main sectors, we can see that how some of these events have also shaped the demand side. Top left-hand chart just shows Chinese coal imports for dry bulk. Now, dry bulk still remains very much a China story, and as we've heard from some of the previous presentations today, we are seeing a sort of slowdown in China. However, during the halfway through last year, we saw droughts in China, we saw a cutback in hydroelectric production of electricity. And as a consequence, we saw China import a lot more coal to sort of meet the deficit in energy. We've seen China continue to import coal since last summer, and as you can see, we're now seeing the largest stockpiles of coal in China that we've ever seen. So China's coal is at record highs. That's obviously been good for demand in the short term. There perhaps are warning signals on the horizon, as that coal will have to be used somewhen and somehow. At the bottom of the bottom left-hand chart, we can see sort of building on the uncertainty in Chinese construction industry, we can look at cement imports into China. And here we can see quite clearly how cement imports have sort of tailed off into insignificance, which does give us a good guide or good bellwether for the construction industry in China, where we've certainly seen some cooling off. However, it's not all doom and gloom. If we look at the chart on the right, that just shows our incremental cargo demand by commodity grouping for dry bulk, and we can see that over the next couple of years, we are going to see continued incremental demand for dry bulk sectors across a range of commodities. The further we go out, we're expecting to see more growth from things like grains and minor bulks rather than coal and iron ore. Moving across to the oil tanker sector, we can clearly see in the top left-hand chart we've got oil demand growth. We can clearly see the ramifications for zero COVID policy being lifted in China, and the implications in 2023, where we saw huge volumes, year-on-year volumes of increases of oil being transported and demand in China. Since then, things have cooled off a little bit from a demand side perspective. There is still growth in South Asia and in China, but we can see from perhaps some of the more developed, the North American, European economies, oil demand growth has slowed and in some instances has actually gone into negative territory. Another policy play in the bottom left-hand chart, OPEC decided to cut back production last year, whereas the North America has continued to go all out on oil and gas production, and we can see that divide opening up there. That, of course, has implications for shipping, has implications for ton miles, which we'll come on to talk about later in the presentation. So we can see on the right-hand side a similar chart to what we had for dry bulk, incremental demand on the oil and chem side, and we can see we are seeing positivity for the next 2 or 3 years. For containers, a similar story, or a similar set of charts at least. Main lane quarterly head haul volumes, top left. We're now seeing those volumes at an aggregated level, the same levels as we saw during COVID primarily. You'll notice that the growth isn't quite as strong for the Trans-Pacific, although for the last couple of months we've seen some very strong numbers being posted there. But generally, their head haul volumes are back to sort of pre-pandemic levels. Where the interesting part comes is the non-main lane trades. And we can see I've put a lot of the Far East trades in the bottom left-hand chart, and that's where we're seeing growth. We're seeing growth primarily due to exports out of China. So China aren't consuming as many goods domestically, so they're exporting them. We're also seeing some near-shoring or friendly shoring take place on the container side. And also we're starting to see the potential trying to sort of think ahead around tariffs, especially tariffs associated with US container exports. So if you look at things like Chinese exports of goods to places like Brazil, to places like Mexico, you'll see some very strong demand signals there. So as we can see on the chart on the right-hand side, it remains a positive picture for the demand side of the container ship industry for the next 2 to 3 years. But where we've really started seeing some deviations, some froth on top of the markets, has been due to vessel operations and efficiencies, and perhaps we need to call them inefficiencies alongside the efficiencies. Now, there have been two mega events since COVID. The first of these has been the Russian invasion of Ukraine. That has predominantly altered trade flows for the energy sectors beyond recognition compared to where it was, say, in 2021. And the chart on the left just shows Russian oil exports to Asia, and we can see that these have gone through the roof. So oil that was going to Europe, relatively short haul, or even via pipeline to Europe, is now going huge distances to Asia. A lot of these refined products are then coming back to Europe, and then Europe itself is having to source crude from further afield. So this has been a huge positive for the tanker industry over the course of the last 2 years. On the right-hand side, we can see LNG and the sort of fluctuations that we've seen in the LNG market since the Russian invasion of Ukraine. We can see the yellow bars, that's LNG being imported into Europe, how that sort of took off during 2022. And now we've sort of seen something of a return to normal, but the thing we haven't seen return to normal in terms of routes is now a lot of US gas is going to Europe, Middle Eastern gas is going to Asia, whereas before US gas was going to Asia. And that's obviously reduced ton miles, and that helps partly explain why we've seen lower earnings on the LNG sector over the last 12 months or so. But of course, the big one, and I know this will come up a number of times over the conference, has been the impact of what's going on in the Red Sea and the Suez Canal, and the deviations that the industry is now having to face for a large number of sectors, where vessels are now going around the Cape of Good Hope rather through the Red Sea and Suez Canal. And these are just two sort of heat maps from our AAS data, just showing you routes for a large product tankers and Suezmax sectors. I think it's important to say that not all sectors are diverting from the Red Sea. Certainly for containers, for car carriers, there's virtually nothing going through the Red Sea. For tankers and bulkers, we are still seeing some traffic going through the Red Sea, so it is one to watch and actually over the course of the last couple of months, we've probably seen more tankers go through in the last couple of months than we had done at the start of this year. And what does all of this mean? Why am I bringing it up in a topic about the market? Well, what it means is that the ton miles have effectively gone through the roof. These 4 series of charts just show you the blue bar is tons, so actually tons on the water, whereas the yellow bar is ton miles. And if we just concentrate on the top left, which is crude oil, 2024, we can see that crude oil tons around 1.5% year-on-year growth. If we look at ton miles, it's closer to 5%. So that's having a huge impact in the demand for tonnage. Perhaps the sector where we've seen it have most impact has been on the container ship sector, and it has been quite interesting. As we know, there's been a lot of containers that have been delivered during 2024, and if you actually do the analysis, we've pretty much seen the number or the volume of containers that have been delivered have pretty much like for like equal the number of containers that have been required to meet the extra distances and the diversions around the Cape of Good Hope to maintain the weekly schedules. So you'll see that on the chart on the left, capacity and deployment. The blue and the yellow bars are almost like for like. So it couldn't have really come at a better time for the container ship industry, given all the tonnage that was coming out of the water. As we can see on the chart on the right, what that has meant now is there's very, very little idle tonnage in the container ship sector. We're down to sort of similar levels that we saw during COVID, and that means that market's incredibly tight currently. So any sort of additional demand has a huge impact, or potentially has a huge impact on TC rates, and that's why we're seeing charter rates at the levels that we're seeing. Even for vessels that won't be delivered for 12 months, we're seeing them fixed at today's levels. I thought I would just throw in a few sort of longer-term views and sort of think points just to get everyone thinking over the next couple of days. And the first one, again, it comes back to China. We heard a little bit earlier about the China slowdown, and these are another series of charts that tries to emphasize the slowdown. And I would say it's a slowdown. We're not saying that Chinese growth is going to stop or go negative, and we're not saying that this has happened overnight. This has been happening for some time. As we can see from the Chinese residential property started, as we can see from Chinese steel output, as we can see from Chinese refineries, we've seen a slowdown for some time. So this is something we've been watching, this is something we've been following, this is something we've been baking into our models. And then if we look at the Chinese population, which is the chart on the bottom right, we can see that we're starting to get quite an aged population within China that won't necessarily be able to contribute to sort of consumption and production within China. And as a comparison, I've put India and Nigeria population profiles on the same chart, and you can see there's a stark contrast between China versus these two powerhouses of potential new growth. And this leads nicely onto this slide, which is about growth. China, as I say, we think some of the growth will curtail somewhat, but India, South Asia, India is waiting in the wings to pick up some of these lost volumes, whether that be on the coal side, whether that be on the crude import side, as we can see on the top two charts. There are also new cargoes that shipping will need to service. Green steel will need HBI and DRI, and we can see from the chart in the bottom left, we're going to need to be shipping around 110 million tons of this by 2050. And one perhaps a little bit closer to home to most people is the sort of new trade in clean methanol and clean ammonia. By 2050, we're going to be needing to ship around 300 million tons of a cargo that at the moment just doesn't exist. We're going to need hundreds of ships to service these cargoes. The energy transition is also something to have an eye on, and how that develops and how that impacts shipping. This comes from our energy model at MSI, where we're forecasting out to 2050. Now, this is going to happen, and it will be something of a slow burn. The thing I think is worth noting from these charts is that we're about in that transition period. We can see up until 2020, there hasn't been a huge amount of change in terms of energy consumption by fuel type, but we're now at that inflection point. So we will start to see less coal being traded and more renewables being used in the energy landscape. That will also have a huge impact to shipping as we move through the lifespan of some of the assets that are being ordered today. So that's on the demand side. Moving on to supply and shipbuilding. Contracting was going great guns last year, and we did see that tail off at the back end of 2023. And then, somewhat out of the blue, contracting picked up tremendously in Q1 2024. And I think that admittedly did catch us off guard a little, and I think it probably caught most people off guard, especially as a lot of those new orders have, again, been from the container ship industry, but we've also seen a lot more tankers being ordered this year. And it seems like those sort of contracting levels are going to continue till the end of this year at least. The thing I would say is, yes, there has been a lot of contracting, but some of that contracting has been very focused and not necessarily focused on the sectors or the size bands where we need replacement tonnage. And that's what I'm trying to capture on the chart on the right-hand side. The chart on the right just shows the order book as a percentage of the 15-year and older fleet. And I've highlighted the red bars where there are potentially over-ordering. The yellow bars are potentially where there's some concern, but you can see the majority of that chart is blue. There aren't enough vessels on the order book to replace the aging tonnage. So it's very much a case of sort of trying to sort of focus in on those sectors and trying to understand where the new demand, the new orders will come from in the future. Something that we have seen go hand in hand with a lot of the container ship orders and a lot of the car carrier orders has been a move to dual fuel technologies. And we haven't still seen this in the dry bulk and the tanker sector. I think for the containers, it's very much close to the end consumer. The container industry currently has a lot of money. Container industry is going to be exposed to European ETS and Fuel EU potentially more than some of the other sectors. And of course, the availability of the fuel. If you're offering on a liner service, you can help secure fuel at either end of that service. China, as a nation, has been outputting a lot of tonnage. 56%, I think, of all tonnage in 2024 has come from China. They've been able to do this by bringing in people from the construction industry into the shipyards. That's helped increase productivity and output. And they've also opened new yards. And we can see our forecast on the right-hand side for shipyard capacity, which is really starting to increase in China. This is something that we've been saying for a while. This is a slide that I presented in 2017 when I was talking about mothballed shipyard capacity. And I said that when the shipbuilding markets start heating up, when they start becoming profitable, a lot of these shipyards just don't disappear. They will become reactivated. They will take some of the strain out of the system. And lo and behold, this is STX Dalian, which went bankrupt in 2015, and now that's had a new lease of life as Hengli Heavy Industries. One thing that the shipyard capacity will help to absorb over the course of the next 5 or 10 years or so is the requirement for energy-saving technologies and retrofits, and we do think that this is going to increase a lot over the next 10 years, given we're going to have to see a lot of ships on the water that have to do something to meet regulatory requirements. And then just quickly, finally, earnings and values. New building prices have been high. Costs have been high for the last few years. We are starting to see costs come off a little bit as inflationary pressure comes down. We do think new building prices will start to soften at the back end of next year as deliveries outpace contracting. As we can see on the chart on the right, there's a good relationship between these two contracts going in and deliveries coming out. If you see more coming out than going in, new building prices do soften. Earnings. Now, of course, the diversions have given some froth to the system in terms of earnings. We think that on the dry bulk sector, that's accounted for around 15 to 20% of the earning value that we're seeing today. On the tankers, more like 10 to 15%. So you do start having to make a call on what goes on in the Red Sea to dictate where earnings will go going forward. But as you can see from our chart on the right, we are still positive for earnings for the next 2-3 years across pretty much all sectors of shipping. Values, we do think will come off as we look out to sort of 2028. This chart just shows you value distributions over time. The yellow bars show you where today's values are. The red bars show you where the values we think will be at the end of 2028. Now, yes, the red bars are further down than further to the left than the yellow bars. However, what I would say, apart from containers, that the red bar is above the mean and median for all other sectors. So a positive story for values in relation to historical averages. And then finally, where are the best investments in shipping? I always like to end up on a slide that sort of tries to give some insight, brings everything together, supply, demand, earnings, and values. And in this investment exercise, what I've done is says, well, you go out and you buy a 5-year-old today, you fix it for 3 years, and then you sell it after 3 years. And where are the best IRRs to be had in the market? And as you can see, the highest IRRs currently are for the offshore sectors. Given where the markets are and where you can fix containers at the minute, they still will yield sort of double-digit territory. But across the board, they are all positive, which is obviously good for the industry. I guess bulkers are the sector where we have potentially the most concern, just because asset values currently are so high in relation to earnings. Appreciate I've gone a little bit over, Andrew, but thank you everyone for your time.